In 2016, Lopez de Prado, one of the most cited quants in modern finance, published a paper arguing that Markowitz's portfolio optimizer had a fundamental mathematical flaw that made it unstable in practice. His alternative used machine learning clustering to build better portfolios without inverting the covariance matrix. Today we break down hierarchical risk parity from first principles. Welcome to Quantify. Classical MVO has three practical problems that compound each other. HRP solves all three simultaneously: no matrix inversion, stable weights under small data changes, and natural handling of the genuine correlation structure in the asset universe. It has been adopted by dozens of institutional investors. Lopez de Prado's 2016 Journal of Portfolio Management paper is one of the most downloaded quant papers of the last decade. MVO computes optimal weights as the inverse of the covariance matrix times expected returns. The matrix inversion is the root of the instability. Matrix inversion amplifies estimation errors. A small change in correlations produces enormous swings in optimal weights. Estimation noise in the covariance matrix gets converted into concentrated, unstable bets. Out-of-sample, MVO portfolios often underperform naive 1/n equal weight. Ernest Chan's Quantitative Trading dedicates an entire chapter to this instability. HRP is built to avoid it entirely. Step 1. Convert correlations into a proper metric distance. Dij equals the square root of 2 times 1 minus the Pearson correlation between assets I and j. The formula by Montaigne ensures this is a proper Euclidean metric distance. Assets that are perfectly correlated have distance 0. Uncorrelated assets have distance root 2. Anti-correlated assets sit furthest apart at distance 2. This distance matrix is the input to hierarchical clustering in step 2. Montaigne first proposed this construction for financial markets in 1999. Step 2. Hierarchical clustering using Ward linkage, which minimizes within cluster variance at each merge step. Ward's method, from his 1963 Journal of the American Statistical Association paper, is standard in financial applications. ETH and BTC cluster together first, they are the most correlated pair. Aave and Uni cluster as DeFi governance tokens. USDC and DAI cluster as stablecoins. The two DeFi clusters merge next. Finally, the stable yield cluster, stablecoins, merges at the root. This tree is the dendrogram that drives the weight allocation in step 4. Step 3. Quasi-diagonalization. Reorder the rows and columns of the covariance matrix so that highly correlated assets sit adjacent to each other. The left matrix has the original arbitrary asset order. Correlated assets like ETH and BTC are scattered. After quasi-diagonalization on the right, correlated pairs are adjacent: ETH next to BTC, Aave next to Uni, USDC next to DAI. The matrix now has high-value cells clustered near the diagonal, a quasi-diagonal structure. This ordering drives the recursive bisection step that follows. Step 4. Recursive bisection. At each branch of the dendrogram, split the risk budget between the left and right subcluster using this formula. Alpha L is the weight fraction assigned to the left cluster. It equals the right cluster's variance divided by the total variance, so the lower variance cluster always receives the larger allocation. The DeFi cluster has variance 0.04 and the stablecoin cluster has variance 0.01. Alpha L equals 0.01 over 0.05, giving 20% to DeFi and 80% to stablecoins at this branch. Recurse down every branch until all leaf weights are determined. No matrix inversion at any step. This is why HRP is fundamentally more stable than MVO. Why does HRP outperform? No matrix inversion means no error amplification. The fundamental fragility of MVO is removed by construction. The dendrogram captures genuine correlation structure. Weights change smoothly when data updates. The clustering is noise tolerant in a way that matrix inversion is not. Empirically, Lopez de Prado's original paper shows HRP outperforms MVO, the critical line algorithm, and naive equal weight on out-of-sample Sharpe ratio and maximum drawdown, particularly when the asset count exceeds 50. The one important input improvement: use Ledoit-Wolf shrinkage on the sample covariance matrix before feeding it into HRP. Ledoit-Wolf shrinks the sample covariance toward a structured target matrix using an analytically optimal coefficient alpha. The shrunk estimate equals 1 minus alpha times the sample covariance, plus alpha times the target. Alpha is chosen analytically to minimize mean squared error, no grid search needed. It is especially valuable when the number of assets is close to the number of time periods, where the sample estimate is most unreliable. Ledoit and Wolf published the foundational papers in 2003 and 2004. In a DeFi yield portfolio, protocol sources Aave, Curve, GMX, Lido have complex cross-correlations driven by DeFi market cycles. HRP on protocol yield return history groups lending protocols together, perpetual DX yields together, and liquid staking yields together. Within each cluster, it allocates inversely to variance. Staking yields, historically the most stable, receive the largest allocation. Perp DX yields, highest variance, receive the least. Use HRP whenever you have a large asset universe, more than 20 assets, and limited history. Apply Ledoit-Wolf shrinkage before feeding the covariance matrix into HRP. Use Ward linkage, the standard for financial applications since Ward's 1963 paper. No matrix inversion is required at any step, that is the fundamental robustness advantage of HRP. For DeFi yield portfolios, group protocols by yield type lending, DX, staking as natural clusters before applying the bisection. HRP is the practical portfolio construction method that finally works well out of sample. That wraps Series 1, Classical Quantitative Finance. 10 episodes from correlation matrices to hierarchical risk parity. Series 2 starts next: how Uniswap actually works. We go from abstract portfolio theory to the on-chain math powering billions in daily trading volume. Subscribe and let's go. Quantitative.